I know there's a lot of fear and uncertainty in the market right now. The last couple of weeks, I know, especially if you're new to trading, you haven't been trading very long, the last couple of weeks seem rather scary because in the last 2 weeks, the market has really had a steep decline, and especially the last two trading days on Thursday and Friday this past week, we saw huge red candles, some of the largest red candles we've seen in really a couple of years on both the S&P 500 as well as the NASDAQ, as well as the Dow. We saw a huge spike in volatility. The VIX had one of the biggest increases that I can remember here in the last year and a half, especially. And as somebody that's an active trader and that I pay attention to things like these various market indices as well as the VIX, I pay attention to them every single trading day. I think this is the scariest time in the market since the last time we saw this kind of fear was the banking crisis back in, what was that, early 2022, when we had a couple of banks fail. What was that, Silicon Valley Bank, and there was a couple of other ones that were kind of teetering on the edge. And of course, that caused a lot of fear and uncertainty in the market. We saw some really steep declines in the market then, as well as we saw a big spike in volatility. And that's kind of what we're getting right now. This isn't related to necessarily a banking crisis. This is really related to recessionary fears, and people actually think we're teetering on the edge to where the market is not quite as strong as what some of the stock charts would have had you think there for a while, because it was really mostly the big mega cap tech stocks that were driving this huge run up in the S&P 500 as well as the NASDAQ 100. It was really Microsoft, Nvidia, Apple, Meta. It was really just a handful of companies that were driving all of the gains, and that was because of all of this craze around AI. And AI, just in those few trillion-dollar companies, this AI craze really was able to overcome what is really kind of a weak market. And the reason I'm making today's video is because some of you guys have some concerns, some questions. Obviously, many of you guys probably watching this video are rather new to trading. You haven't been trading that long. Maybe you just got into it here in the last few months. And in the last few months, the market has done nothing but just stair step up. It just went up all the time. And of course, you get into the habit, you get into the same routine of, I'm just going to play a whole lot of bullish strategies and I'm just going to essentially print money. It's basically free money in a market that is doing nothing but going up. Constantly putting on bullish strategies, it just seems like so easy, right? And then all of a sudden the market has a correction, a severe correction. Now what happens? Well, now you're looking at your account and you have thousands and thousands of dollars of unrealized losses, or in some cases realized losses if you have to close positions. Maybe in some cases you had to close some positions because your buying power exploded. You were using 60, 70, 80% of your buying power for whatever reason a couple of weeks ago, and then because the market has seen such a steep decline, and you had some bullish positions, all of a sudden your broker is requiring more buying power from you, and in some cases you may have even received a margin call where you either had to deposit more money to cover that buying power requirement, or you were forced, again, in some cases, to go ahead and close positions, realizing some massive losses. And unfortunately, it's one of those things in both trading and in life. Sometimes you have to make some critical mistakes in order to learn. You have to burn your hand on a hot stove at least once before you realize, hey, don't touch that hot stove. And that's what has happened here with some of you guys. Some of you guys just had too much of your buying power in use on all of this run up here in the S&P 500. You were using a lot of your buying power. You put on a lot of bullish positions. You took some really big positions in some cases. And then all of a sudden, this happened the last 2 weeks, right? Where you saw the S&P basically shed about 400 points or so from the high point to the low point on the bottom wick of this candle. That is a pretty severe correction. If I go to the chart for the NASDAQ, this looks even uglier. You can see the NASDAQ has sold off, about 3,500 points or so. And these are ugly candles. I mean, this is like a 2.5% move. This is like a 3% move on this candle. And if you're talking about like the last 2 weeks, I mean, we're down. I'm just guessing. I bet that's probably a good 5, 6, maybe 7% decline in the NASDAQ 100. And that is a big move. If you were way too long the market, if all you had on was a bunch of bullish positions, you got run over a little bit. And naturally, folks want to know, hey, what caused this? Why did the market all of a sudden start going down and down in a big way? And I always talk about, you really can't predict the markets. Markets are random. And when I say you can't predict markets, we can't predict tomorrow. We can't predict the future, but we can go back and take a look at the past. And I can tell you what caused, especially this last week of moves, this big down candle and then the big up candle and then the two really big down candles, is because of the Fed report and their decision to not do anything with interest rates just yet. There are many people in the market that think that the Fed has gone way too long without reducing interest rates, because the longer you keep the rates higher, the more pressure it puts on the market. And you're basically in a situation where if you keep rates too high for too long, you are going to cause a recession. And in some cases, you will actually cause a crash, a very severe, steep and fast crash. And the Fed has been fortunate. The reason they've been able to keep rates higher for longer is because of that AI boom, right? It just so happens that the AI boom saved the economy for the most part because of these companies like Microsoft and Nvidia and Meta and all the AI companies, and especially the chip manufacturers. Those companies have had such a good year, especially the last year and a half, I would say. They have really outperformed everything else. And even though the rest of the market is kind of weak, those mega cap tech stocks have really kept the market upright. So even though keeping rates higher for longer should be forcing the market to come down, it should be causing a recession, the AI boom has kind of offset it. But now that AI boom has kind of played itself out, and now keeping rates higher for longer is a bad idea. I think for sure the next meeting they have to cut rates, and honestly they may need to cut rates before that. The way the stock market has acted here in the last few days, all of a sudden you do see some people actually saying, hey, you know what, you've already waited too long, you should have cut rates at this last meeting. And there is some economic data that kind of supports that, because we had a very bad unemployment rate number that came out that is really pointing to, hey, this market, there's some problems with it. And if we keep going the way we're going, there is going to be a pretty severe recession. And a good indicator of fear and uncertainty in the market, of course, is the VIX. So let's take a look at the VX futures, the VIX futures. So that would be /VX. And you don't get a candle like in this candle right here very often, where VIX really, if I take 2 days, the VIX went from 1565 to 2250. That is an absolute explosion in volatility. And for those of us that sell options, which is mainly what I do, it's mainly what I talk about on this channel. And if you follow my content, chances are you're an option seller. And what did you see here in the last few days? You saw massive losses. Why did you see massive losses? It's because volatility is working against us. Because when we sell options, we want volatility to decrease, not increase. And what did we get? We got a volatility increase, not just a volatility increase, an absolute volatility explosion. This thing just straight to the moon. And right now, if you're short puts, short calls, short strangles, or even spreads like, credit spreads, iron condors, you're probably seeing some rather big losses on all of those short option strategies. And naturally, some of you are asking, hey, what do I need to do to help with some of these losses that I'm seeing on my positions tab right now? And honestly, in many cases, there's not much you can do. First of all, let's talk about defined risk strategies. So defined risk strategies, we're talking about spreads. We're talking about your credit spreads and your iron condors. There's really nothing you can do with those because they were defined risk strategies. You've already kind of got a built-in stop loss with them. The built-in stop loss is the fact that they are defined risk strategies. So if you're already essentially seeing a max loss on them, you've already seeing nearly 100% max loss on your positions right now, and there's nothing you can do. You're stuck in it. All you can do is just hold on to those defined risk strategies and hope the market sees a turnaround and maybe you can get out for less of a loss. But essentially, you're kind of stuck in those positions if they're a defined risk strategy. Now let's talk about undefined risk strategies. So we're talking about your naked puts, your naked calls, your naked strangles. You can adjust those because those are a little bit more flexible. The first thing you might consider doing is rolling. rolling out in time and rolling up or down in price to get yourself in a little bit better position. But because the market has moved so far down, especially for your short puts, now some of your short puts are maybe so far underwater that rolling is really not an option anymore. So at that point, you've got to start considering, hey, do I want to accept assignment of the underlying? And in many cases, you don't want to do that. Or do I just want to go ahead and accept the loss, close the position, realize the loss, and move on? And I would say, especially for newer traders, that's always the hardest thing to do. It's one of the hardest things that I had to learn, was sometimes just take the loss. And here's what I'm going to recommend. If you're seeing any of your positions right now that are underwater, say 300% of the credit received. So a 300% loss right now means you suffered 3x loss as far as your initial credit received when you sold that put. You're saying that the position is down 300% right now. Maybe go ahead and close it. Just have that as a kind of a mental stop loss. When you see that 300% number, just go ahead and say, you know what? The trade beat me. There's nothing I can do about it. Just go ahead and close the position. And honestly, when you close these positions, these underwater positions, you'll feel better about it. It'll suck for about 30 seconds when you realize, man, I just lost a few $100s, a couple $1,000s, whatever it happens to be. But then you'll actually feel better because you'll sit back in your chair and you'll realize, man, I'm glad I'm out of that, because who knows what the next down candle could be. It could be an even bigger move to the downside where you really could have put much of your account at risk. And I think these kinds of down moves, they're healthy. They're healthy for the market. They're also healthy for your account if you know how to play them right. And one of the things is you have to learn never to have too much of your buying power tied up in trades. When I say keep 50% or less of your buying power in use, the reason is for events like this. So you have some money on the side, because when VIX explodes like this, what do we always say about selling options? It's best to sell options when volatility is high. And we haven't seen volatility this high in forever. I mean, I'm looking at VIX going back at least the last 6 months here, and it hasn't been anywhere close to the level that it's at right now. So now would be the perfect time to sell a lot of short option positions. But some of you guys have too much of your buying power already in use. You were really using a ton of your buying power a couple of weeks ago. You were already, using 60, 70, 80% of your buying power. And then with the move down, your buying power requirements for some of your positions exploded to where maybe you've got nearly 100% of your buying power in use right now, and you can't do anything, even though now is actually when there is the most opportunity. One of the more famous trading quotes out there is, "It's time to buy when there's blood in the street." And that's absolutely right. The time to buy is when there's blood in the street, is when markets have a lot of fear and uncertainty. And when the market's going down because everybody else is selling. That's when you need to start buying. And the reason is because those are going to be the cheapest prices. When the market has a steep correction, then you're going to find things trading at a severe discount. For example, if you wanted to get long some of those tech stocks, but you were thinking, well, they've just been too high for too long, like Nvidia. Once Nvidia had this run up to $140. Well, right now, Nvidia is trading at 107. So it saw, like a 25-30% correction here, and who knows where it may be trading tomorrow, or it may be trading $100 or less. So if you're somebody that holds a long-term portfolio of stock and you think Nvidia is a good long-term play, but you didn't like it at $140. Well, if you like it at $107, now is the time to buy. Another one, Amazon. Amazon had a horrible earnings report. Actually, the earnings report was fine, but it still saw this huge drop after earnings, where it dropped all the way to about $160 at one point. It finally finished the day at $167. But you can see Amazon was trading at $201 just 2 weeks ago. So again, trading at a severe discount, that's a good, like a 15-20% discount on Amazon. So if you want some long-term shares of Amazon, if you want it for your portfolio, now is the time to get into Amazon. Google is another one that has gone from 192 to 166 here just in the last couple of weeks. Another company that for me personally, I'm kind of bullish on. I don't currently have any shares of it, mainly only I haven't purchased any shares of it recently is because, from its high of nearly $227, it has done nothing but go down. And this is not just the last couple of weeks. This is really for a few months now. AMD is all the way down at 131 now. That is a very steep discount on AMD. Again, if you were wanting AMD shares, if you wouldn't mind having some of those shares in a long-term portfolio of stock, now is the time to buy. Again, the time to buy is when there's blood in the streets. So I know the last couple of weeks have been rough, especially the last 2 trading days have been very rough for us that are mostly bullish players. We play everything to the upside, but you need to be able to see the good and the bad in every situation. So the bad, obviously, it's negative for your P&L, right? The last couple of weeks have been pretty bad for your P&L. You took a few lumps. Hey, that's bad. But you also need to understand what's good about this situation. First of all, it's a learning experience, right? You had to experience something like this so you know what to do, not just now, but also in the future. You see the mistakes you made this time around, so maybe don't make those same mistakes next time. Don't take too large of a position in anything. Don't use up too much of your buying power, things like that. And the second reason this is a positive is because of the opportunity it provides. You have both a buying opportunity. If you want to get long shares of stock, now is the time to buy because those shares are cheaper than they've been in weeks. And also, if you're an option seller, now is the time to sell options because as option sellers, what are we selling? Well, we're selling volatility, and we want volatility to be high, and volatility is higher now than it's been probably in the last 18 months. I didn't go back on the VIX chart to see when the last time we saw a VIX this high was, but it's certainly been at least a year or more since we've had VIX like this. So this is a perfect opportunity to go ahead and sell some puts and sell some strangles if you're doing defined risk, sell some credit spreads, sell some IR condors. But if you're doing any of this, always remember the #1 rule to trading: stay small. Peace, guys.